I want to welcome every one of you, and I know that there's a bunch of you who are going to be listening to this on recording, so all of you, welcome. There we go. Some of the audio popping in. So make sure you know how to mute and unmute yourselves when you join so that we don't get that issue popping up again. All right, well, welcome, as I said, and let me remind everyone that the information shared by community members is for informational purposes only. It is not meant to be financial or investment advice. Any results described in community member testimonials, well, they are not indicative of their results individual investors majority expect to achieve. Neither investors nor any other third parties verify the truth or accuracy of any of those results described in any testimonials that you may hear. Trading securities and other financial instruments, well, it can result in high risk and losses. And the losses can exceed amounts invested where any form of leverage or borrowing, etc. is used. So make sure that you know that any information shared is given without regard to everybody's financial sophistication, situation, time horizon, risk tolerance, etc. It is not financial advice. It is not investment advice. Everyone is on their own. You should be able to take responsibility for your actions, and any trades you make, they are yours alone. No one is going to take responsibility for that. So with that being said, I'm going to pass the ball over to Matt. Let's see. Hello, Matt.
We are going to be doing a session that takes approximately 12 months, but it doesn't, most of the material will be new throughout, or much of the material will be new throughout. The first few weeks are, for those of you that have done this before, this is interesting, my machine it's not allowing me to put this up. There we go. For those of you that have been through this before, the first few weeks will look familiar, but there have been some minor changes to some rules, and we're going to re-emphasize things a little bit differently. For those of you that have not been through this before, I give homework. Everybody is in a small group. The homework is straightforward, but not necessarily easy. And if you do the homework, you will do really well, and I'm hoping that your investing will get better. If you don't do the homework, it's like watching a trading room. It can be entertaining, but watching alone doesn't actually give you money. Evie already went through the disclaimers. My simplification of the disclaimers, and you've heard them read in a very legalistic and rule-based way, which is important. The simplification for that is I'm an adult, you're an adult, I'll take responsibility for my actions, you need to take responsibility for yours. And that's how we'll operate. So let's set the stage for the next few months worth of work. This is a group of adults for adults. You should know that everybody, Evie spends a lot of time on this, I spend a lot of time preparing material, Evie spends a lot of time managing things, other people volunteer, we'll have other speakers, etc. It's all done by volunteers. So please understand that everybody here is just like you. They're spending their own personal time trying to get better as an investor and as a trader, and trying to help others get better as an investor and a trader. So no one here is getting paid. You can't expect that we will be able to bow to any whim. That said, we want you to succeed. Otherwise, we wouldn't spend all of our time doing this. So if you have ideas or want things done differently, let us know, and we'll see if we can do it. I'm going to ask that everybody please try to do things before you cry for help. I guess would be the simplest way to say it. There's an awful lot of times when people spend 3 minutes trying something and then 25 minutes whining about it not working the way they wanted. So I'm going to just ask that everybody please make every attempt they can to try to do it. Use a small group. There's a chat in Skype, and then there's also the community. Between all of those resources, there should be something that will help you be able to do this work and learn it. There is nothing here that everybody that's gone through basic and advanced options can't do. If you haven't done those classes, this will be harder, but I actually will teach you everything you need to know. You just may have to spend a little more time on the homework. And this fourth bullet is kind of a personal gripe. Most failed investors and traders spend more time reading, watching, whining, than investing and trading and analyzing their own results. So please do the work. I will be doing real money trades. They are my money. I'm trying to do real money trades because real money behaves slightly differently than paper, and my emotions are not paper. Your emotions are not paper. The reason I use real money is that it teaches a little better than using paper money. However, I may not make money on every one of my trades, and you may not learn on every one of these trades. You may learn something not to do, but I am not taking responsibility for any trades that you copy. Inside the community, there are, I mentioned these small groups. There's an October 22nd thread in the Haley Portfolio Managers community group. And in there, there's also links to a variety of times that small groups meet. Please, all of the small group leaders seem to be open to new members, and it helps an old group to bring in new blood, because sometimes there's things you think you know until you get the question, and then you go, I thought I knew this, well, let's work on it together. So please, there's some great help in being in a small group, both as an experienced leader or an experienced person in the group, as well as somebody new.
Matt, before you move on from the group situation, when you're done with your intro, perhaps we can go ahead and I can take the ball back and show people how to find information about the groups, because there seem to be some questions coming in through the chat.
That would be awesome. Why don't we show them how to, can I suggest we do 3 things there, Evie? Maybe show them how to find information about a group, where I publish the documents before or right after a class, and also where you post the ARF readers, or I'm sorry, the files that can be read.
Absolutely, yes. I've been planning on doing it all. So whenever you are ready, we can do that.
Okay, well, you're way ahead. Thanks. All right, our objectives. Our objective here is to make you a better investor. I use diagonals as a means to that end, but I don't care if you ever trade a diagonal in your life. I find them very, very powerful. Does not mean it is the right strategy for you. So the goal is to make you a better investor. To do that, you have to manage your portfolio better. And your whole portfolio is what you care about. You may have to get better at just doing investing in general. How do I move from being just a technician to using fundamental analysis? How do I understand what's going on in the rest of the world? How do I understand when the Fed says something, or the Japanese version of the Fed, or the Chinese version of the Fed says something? What does that mean from an economic standpoint, and what does that mean from an investing standpoint? So our goal is to increase your returns in your portfolio. That requires that you get to be a better investor, and I'm going to use diagonals to do that. And I use diagonals because it is a fundamental trade, and it has a short component. Because it is a fundamental trade, the trends of the market, therefore the economics matters, the fundamentals of the tickers matter, the fundamentals of the geography and the sector matter, and the technicals matter for entries and exits. So the diagonal forces us to learn how to do all of the things above. But my goal is not to make you a diagonals trader. My goal is to make you a better investor. Does that make sense to everybody of why we use diagonals? What I should have said along the way is that please chat any questions and make sure you copy to everyone in the chat. And then Evie is much better at following the chat, and that's being polite, than I am. So she will interrupt when I ignore things, because to be honest, I do have the chat up, but it usually is behind something else. So what I'll try and do is at the end of every slide, we'll for the new people, we will address any questions leading up to that point at the end of every slide.
Yeah, so so to make sure you send it to everyone, right above the box where you type, there's a send to, and I think it probably somehow defaults to host or something like that. Make sure you change it to say everyone, and it should be the top item from the drop-down menu there. Thanks.
All right. I mentioned at the very beginning that we're going to change some things from previous sessions. We're going to be using fundamental research that comes from Stansberry and Associates, and we're going to probably be focusing on research from Porter Stansberry, Steve Sugarud, Doc Eifrig, and maybe Dan Ferris. And so the reason for that is I believe fundamental analysis is key to success. You can trade well, but in the long term, you cannot trade your way to wealth. You can invest your way to wealth. There are very few traders that make tremendous amounts of money. And even those that do make tremendous amounts of money in trading, their definition of a trade is quite often a year to 18 months long, which we might think of as an investment. So fundamental analysis is critical. Some of the best fundamental analysis newsletter material comes from Stansberry and Associates. That does not mean I agree with everything they say. What it means is that they do a good job of writing why they believe what they believe. They keep their history alive so you know what they've been saying, so if you agree or disagree, and you can look back and see why they've done what they've done. And it will, I hope, make you a better investor if you use good research. In the past, we focused on teaching people how to read 10Ks and 10Qs, and what I find is that everybody sits through those 2 sessions, they say they're going to do it, they all think that it's important, and then no one ever does it. So instead of saying, you know, learn your times tables and memorize your times tables up to 15 times 15, I'm going to say, let's get up to 5 by 5, and then let's use the calculator above that. Our calculator here is going to be Stansberry and Associates for that metaphor. That doesn't mean, like I said, that I agree with everything or that you will agree with me. Part of what we want to do in this session is teach you to critically evaluate what you read or what you hear. For those of you that have been around my sessions in the past, you know that I think of CNBC as comedy channel for investors, that just as Jon Stewart does a nice hint of what's going on in the news, if that's your only source of news, you're probably pretty uninformed. You're better informed than if you did nothing, but you have a biased view of the world. The same is true of reading something from Stansberry and not thinking about it. They have some great research, but I don't agree with all of it, and I'll tell you why I agree or disagree as we go. And you may find you agree with them, you may find you agree with me, or you may think we're both out to lunch, and that's perfectly fine. We're going to do a lot more analysis, and we're not going to do it all in one week like we tried to do it in the past. Sprinkled throughout the next few months, we're going to spend a lot more time learning how to do risk-adjusting measurements of your returns. And by that I mean, let's figure out how well did you do, then how well did you do compared to a benchmark, then how well did you do according to a risk-adjusted benchmark. If you take more risk, you should have more reward. Not understanding how much risk you're taking and getting better rewards doesn't mean you are a better investor. It means that you are ignorant of some risks, and ignorance can be solved. Stupidity can't, so if you refuse to learn, there's nothing anybody can do. If you didn't know something and you get better at it, then that's great. So I don't mean ignorance in this big insulting way. We're all ignorant of many things. What we want to do is make sure that we do a better job, all of us, including me, of evaluating how we do on a risk-adjusted basis. We're also going to talk a little bit about taxes. I will not be giving tax advice. However, I will be bringing up some issues that you should talk to a tax advisor about. I do not recommend tax advisors. I don't even recommend my own tax advisor, even though I like him a great deal. Tax advice is something that's so personal. You need to find somebody that you like, that understands your whole life, not just your trading life, and you can work with going forward. But ignoring taxes, ignoring trading expenses, etc., will lead you to thinking you're doing much better than you actually are. And so, while I won't be giving tax advice, we will talk about whether or not you're trading in a taxable account, or did you make the mistake of doing GLD or SLV or something like that in a 401k, and what do you need to avoid doing so that you don't have an ignorant tax hit, just because the rules are opaque, to be polite. In the past, we've done a few books. I think we will pick different books this year. I think we learned a lot from books in the past. We will do them a different way going forward, though. In the past, it was way too much me doing a book report instead of people contributing, and so we'll find another way to do that going forward. And if books isn't the way we want to do it, we'll find something else to make sure that we keep learning. Does this make sense for trying to adjust from past years? One other change that's not a material change is I am adjusting some of the accounts so that we will have much less replication of trades in different accounts. But we'll talk about that as we get forward.
Very good, Matt. These changes seem to be very well received. So I think we are on to a good start.
Excellent. So, syllabus, what are we going to do? We are going to talk about price-based and time-based trades, and we're going to talk about the rules for my version of a diagonal. Now, there's only, what, 1, 2, 4, 6, 8, 10 items here, and we're going to do 2 of them today. So that would imply, of course, that in 4 weeks we'll be all done, right? But in reality, it takes us a little longer to get good at what we cover. So we'll cover the material, then we're going to go back and cover it in a little more depth, and then we're going to apply those to investments, and we're going to apply those investments to portfolios so that we all get better, okay? So diagonals as a function of learning price and time-based trades. We will go over the Greeks again. So for those of you that are not familiar with the Greeks, I assume that everybody remembers the definitions of the Greeks. What we want to get better at is understanding that if IV goes up, what happens to theta? Or what is my gamma risk over a long weekend? And how does that change if there's news? You know, those kinds of things. So moving from the definitions of the Greeks to how does it address or impact my investments and therefore my portfolio. We will talk about trade setups, we'll talk about roles, and of course exits, not just entrances. Roles are key as well, and we think of a role as a new trade. So we would evaluate whether or not we want to still be in the trade when we do a role. We'll look, as I mentioned, pretty detailed at benchmarking and allocations. We'll look at making sure that we have a posture and that what are the trade drivers from that posture. Our posture is not going to be as simplistic as I'm bullish, I'm bearish, I think the market's going sideways. It may well be that I think Europe has been overly hit, the U.S. has been rewarded very well. If interest rates rise in the United States, then emerging markets in China and Brazil are going to be hit the hardest, and so I'm bearish on Brazil, I'm bullish to neutral on the United States, and bullish on Europe, and I am also bearish on commodities, or something along those lines. So we're going to move away from a very simplistic approach to the world. We have to understand the simple first, but that's not sufficient for a portfolio. We're going to talk about risks, understanding them and managing them. We'll do reading and executing on newsletter research, as I mentioned, and we're going to use Stansberry because I think very highly of them. And then we're going to still do one session on 10Ks and equivalents, because if you disagree with what somebody is saying, you need to be able to dig in and understand, are you right or are they right? And then we'll have some added material. The books I'm thinking about right now is one from Meb Faber and one from Jim O'Shaughnessy. They're both excellent investors, and I think we can learn a lot from both of them. They also take very different perspectives on the world. Meb believes very strongly in active management. He's a very, very smart guy, runs some actively traded ETFs. They are not index-based, and so whether you like his approach or not, we can learn a ton from him. He's just a really bright guy. Jim O'Shaughnessy is also an extremely bright guy. I would put it as not a simplistic, but a a simpler version of some of what we got from Fisher, some of what we got from Siegel, but it's more of a contrarian view, but not counter trend, if that makes sense. So anyway, those are the ones that I'm thinking about right now, but we're open for other ideas. I know psychology of investing is important. You will not get that from me. I am not the warm and fuzzy guy that's going to try and hold your hand through the trade. I'm going to tell you to either make the trade or not. If you want to make the trade, I'll help you set it up. If you don't want to make the trade, great. But you know, I'm assuming that you're getting your support, unfortunately, someplace else, because that is not my strength. All right, some simple things.
Question, Matt, before we move on. Do you have any thoughts on the books by Meb or Jim?
I'm going to reread the Faber books and pick one. And then the O'Shaughnessy book is probably going to be Predicting the Markets of Tomorrow. Okay. The book is Predicting the Markets of Tomorrow, and I'll post that. I've read it, but it's been about 9 months since I read it, and sometimes things that I think are in one book might have been in something else. So I'm going to go back and reread that book and reread. The Faber books are very easy reading, very good, but not overly long. So that's the thought right now. And if other people have books that they would recommend, you know, I'm open. But if it's a here's how to feel good at night kind of a book, I'm sorry, I'm not the right guy to do that. And that doesn't mean that we can't do it. It just means somebody else is going to have to lead that.
Thank you, Matt.
All right. Some simple guidelines for investing. And you guys that have been around me for a while have heard this all before. You can learn from a new mistake. If you duplicate an old one, it means you're not learning. I will tell you a lot of the mistakes. I can't remember every mistake I've ever made, but I will tell you a lot of the mistakes I've made. Please invent new ones. Don't duplicate the old ones. Being early is a euphemism for wrong. I have been early. I lost money. That means I was wrong. In options, it is even more important because you are not only taking directional risk, you are taking time risk. So you can be making money over long periods of time, even if you're wrong in the short term, if you buy the equity or buy the commodity. That is not true in the option world. There is time decay. It is small but inexorable, and therefore being early is wrong. I think we all right. Since bad stocks fall faster in a bear market and good stocks rise faster in a bull market, that means that the fundamentals matter. If you can identify horribly run companies in lousy industries, then when the market goes bearish, those are great shorts. Those are great long puts. Everything, you know, we all say that the, you know, all boats rise in a rising tide, but boats that have holes in them rise less. So finding the good stocks, you will do better. All stocks may go up in a bull market, but you might be able to get 20% better returns by being in the better stocks. Okay, being in the right industry and the right stock, according to a lot of 30% better returns than the average. The average is still good. You want to be in the trend. Knowing the trend is important. Otherwise, Rule 2 applies. Thinking that we are going to have a pullback, or thinking we are going to have a correction, or thinking that we are going to have a bear market, all of those facts are, those thoughts are true. But I don't know when they are, and I suspect you don't either, and therefore trade what you see. Just because you don't know about a risk doesn't mean you're not taking the risk. If you don't know what portfolio risk is, then that doesn't mean that you aren't taking portfolio risk. or interest risk or any of a magnitude of risks. There's going to be one session that we talk about 20 different kinds of risks, 23 I think it is, of which you're probably fully aware of 15, maybe 2 or 3 of the rest don't apply, and a couple of them are going to go, oh my gosh, I never thought of that. Well, even if you've never thought about it, doesn't mean you're not taking that risk. So we're going to try and be better informed. I believe, and these are my guidelines, therefore you're going to get my beliefs. If you don't understand what you're trading, then it is not a fundamental-based investment. It is, a gamble at some level. If you don't know what the company does and you just like the ticker, then you're betting that in what's called the greater fool's theory, that because I know nothing, somebody that else will buy from me at a higher price than what I buy today because there is somebody else that knows even less than I do. And that works a lot, but when it fails miserably. You can't know what risk you're taking if you don't know what industry the company is in. You can't know what risk you're taking if you know the industry but don't know who they sell to or where they're located or anything along those lines. So you can do swing trading, but when swings go against you, we all know that they go bad. So in this session, we will only trade what we understand. And I would strongly believe that if you can't make money in stocks, adding the time risk and leverage does not improve your odds. So if you can't make money in stocks, it's really, really hard to make money in options. All right, so before we get started, why don't we have Evie, you go through the site. No, and if anybody has any questions, as Evie said, there's a ton of people that are really, really helpful. And you may hear from somebody where you don't recognize their email or their name at first, but Louise and Francois, Kit, et cetera, there's a lot of people that their email may not match the name that you see posted here. So as I say, there's lots of people willing to help, and we ask that you be willing to help others as well. That's simple.
That's wonderful. And while you were talking, Matt, I brought up the Skype chat, which is called the Haley Portfolio Managers here. So you can see there are a lot of people. Most of them are not my contacts, where it has a question mark. I'm not a contact with this person, but that doesn't mean that I still can't interact with them, and so can you. So you see there are loads of people here. Most people are pretty silent, but there are a few of us who are active and chat here on Skype. All right, unless there are any questions, we'll move on to the next session, next part.